You didn't lose that trade because the setup was wrong. You lost it because you entered one candle too early. And the cruelest part? The setup worked. The breakout happened. The move you saw coming played out exactly as you predicted. But you were already stopped out when it did. You watched it move without you. And you still don't understand why. That is what this video is about. Think about how it happens. Every time. They identify a level, a resistance zone the price has touched 3, 4, maybe 5 times before without breaking through. They watch. They wait. Price approaches. One big green candle starts forming, pushing toward that level with momentum and confidence. And something fires inside them. The heartbeat quickens. The body says, "This is it. This is the one." So they enter. Price breaks through the level by a few points. They feel vindicated. Then the candle closes. Not above the level, below it. The body of the candle wicks up through resistance and comes back down. Their stop gets hit. A few seconds later, the next candle opens, and it climbs, and climbs. The breakout they called correctly plays out over the next 2 hours without them in it. They close the chart. They feel sick. Why does this keep happening? Why do I keep entering at the exact wrong moment? The answer is not your analysis. Your analysis was right. The answer is your timing, and specifically, the difference between anticipating a breakout and confirming one. Those two things feel almost identical in the moment, but they produce completely different outcomes over hundreds of trades. Here is the first thing to understand. A breakout is not an event. It is a process. When amateurs see price touch a resistance level and push through by one candle, they see a completed event. They see confirmation. They feel certainty. They enter. But price touching a level is not a breakout. Price holding above a level is a breakout. And you cannot know whether price will hold above a level until the candle closes. This is not a minor distinction. This is the entire game. A candle that is in the process of forming is a living, breathing, unpredictable thing. It can extend 10 points in your direction, then reverse 20 points against you, then close somewhere in the middle. You do not know what a candle will do until it finishes. And entering while it is still forming means you are not trading what the market has done. You are trading what you hope the market will do next. That is not analysis. That is a wish with a position attached to it. The professional does not enter a breakout setup while the candle is still forming. The professional waits. And waiting, when every instinct in your body is screaming to click the button, is the hardest discipline in trading. An amateur sees momentum building toward a level and enters because he fears missing the move. A professional sees the same momentum and says, "Let me see where this candle closes." An amateur enters the moment price breaks through resistance because the break itself feels like proof. A professional enters after price closes above resistance because the close is the only proof that matters. An amateur measures the entry from the first touch of the level. A professional measures the entry from the confirmed close above it. 3 different decisions, 3 different outcomes. Same chart, same setup, same market. Let me tell you about a trader named Priya. Priya had been trading for 14 months when she came to understand this problem. She was not a careless trader. She studied her charts every evening. She tracked support and resistance with discipline. She could identify textbook breakout setups with accuracy that impressed even experienced traders who watched her analysis. And yet, in those 14 months, she had turned a $12,000 account into a $7,400 account, a loss of nearly 40%. Not from reckless gambling, from one repeating mistake. She was entering one candle too early, every time. She went back through her trade journal and reviewed 63 breakout trades she had taken over 6 months. What she found was almost unbearable to read. In 41 of those 63 trades, that is 65%, the candle she entered on did not close above the resistance level. It wicked through. It tested the zone. Then it came back. And her stop was placed just below the zone, so when price returned, the stop hit. Of those 41 trades she entered too early, 38 of them eventually broke out in the direction she predicted. She was right about the direction. She was simply wrong about the timing. By an average of 1 candle. She ran a second calculation. If she had waited for each candle to close above the resistance level before entering, her win rate on those same 63 setups would have been 58% instead of 34%. Her average loss per trade would have dropped from $310 to $140 because the stop placement after a confirmed close is tighter and more logical. Priya did not need a new strategy. She needed 4 seconds of patience, the time it takes for a candle to close. Let me give you the mathematics of why this matters so much. On a standard breakout setup, when a trader enters while the candle is still forming, in other words, as soon as price breaks the level, the historical rate of that candle wicking back and stopping out the trade is approximately 62 to 68%, depending on the asset and time frame. That means 6 or 7 out of every 10 early entries get stopped out before the breakout actually develops. Now consider what happens when you wait for the candle to close above the level. The same studies on breakout behavior show the false break rate drops to roughly 28 to 34% on confirmed closes. You cut the rate of getting wicked out nearly in half simply by waiting. But the impact compounds further, because when you enter on a confirmed close, your stop placement is different. You place the stop below the low of the breakout candle itself, the candle that just closed above the level. That stop is tighter. It is more logical. It is protected by the structure the market just built. When you enter while the candle is still forming, your stop goes below the level you are trying to break, which means you are exposed for the entire travel back to that level. The distance between the entry price and the stop is larger. The risk per trade is larger, and the probability of hitting that stop before the move develops is dramatically higher. Smaller stop, better probability, same trade. The difference is one candle. Write this down. Risk is not only about the size of your position. Risk is about the quality of your entry. A bad entry inflates your risk even with a correct position size. Now let us talk about why so many traders cannot wait for the close. Because understanding the mistake is not enough. You need to understand why the mistake feels unavoidable in the moment. When you see a big green candle forming and driving price toward a level you have been watching, your brain does something automatic and ancient. The pattern recognition system that helped your ancestors identify whether a movement in the grass was a threat or an opportunity fires before you have time to think. Your amygdala, the brain's alarm system, responds to the visual of momentum as if it were a physical threat you must react to now or miss forever. At the same time, your dopamine system, which governs anticipation and reward, lights up when the setup you have been watching appears to be confirming. You are not feeling excitement about what has happened. You are feeling excitement about what you believe is about to happen. And that feeling of anticipated reward becomes almost physically indistinguishable from certainty. This is FOMO, the fear of missing out, operating at its most physiologically powerful. It is not a character flaw. It is not weakness. It is a deeply wired survival response being applied to the wrong situation. The market will not move so fast that it leaves you behind. But your nervous system does not know this. It treats a breakout candle forming on a chart the same way it would treat a bus pulling away from a stop. If I don't move now, I will miss it. The professional has trained himself to recognize this feeling as a signal, not to act, but to pause. When the urgency is highest, discipline is most required. When the candle is still forming and every cell in your body says enter, the professional says, let me see where this closes. Here is the protocol. 7 steps. Follow them in order on every breakout setup you ever take. Step 1. Mark the level in advance. Before the market opens, identify your key resistance or support levels on the higher time frame. These are levels where price has reacted at least twice before. Write them down. Mark them on the chart. When you have a clear level defined before price approaches it, you have time to prepare your response. Traders who get caught in early entries almost always fail at this step. The level was not pre-marked, so the approach feels urgent and unplanned. Step 2. Set an alert, then look away. Once you have marked your level, set a price alert to notify you when price approaches within a defined range. Then close the chart. This is not avoidance. This is protection. Watching price move toward a level in real time activates every psychological trap you have read about in this video. The alert removes the watching. You will be notified when the moment arrives. You do not need to witness every tick leading up to it. Step 3. When the alert fires, watch but do not touch. Return to the chart when the alert fires. Observe price behavior at the level. See how it reacts. See if there is a strong push or a slow grinding approach. See what the volume looks like. Volume should be expanding, not contracting, on a legitimate breakout. But observe only. The candle is forming. You are watching, not trading. Step 4. Wait for the close. This is the step that separates you from 90% of the traders in the same setup. Wait for the candle to close. Not to push above the level. Not to break through by 10 points. Close. A closed candle is a recorded fact. An open candle is a rumor. You trade facts. Step 5. Confirm the close quality. After the close, evaluate it. Did the candle body close convincingly above the level? Or did it close only barely with a large upper wick pulling back? A strong close has most of the body above the level with a small wick. A weak close has price barely above the level with a wick longer than the body. The strong close earns the entry. The weak close earns a pass. Step 6. Enter on the next candle's open or on the retest. 2 entry options are valid after a confirmed close. The first is entering at the open of the following candle, the first candle after the breakout candle closes. The second, and higher probability option, is waiting for a retest. After a genuine breakout, price often returns to touch the level it broke through before continuing upward. This retest gives you a lower risk entry with a tighter stop. Not every breakout retests, but when it does, the entry is cleaner, the stop is smaller, and the conviction is higher. Step 7. Place the stop below the breakout candle's low, not below the level. This is the final confirmation that you have executed this correctly. Your stop goes below the low of the candle that confirmed the breakout. If you find your stop is below the resistance level you just broke, you entered too early. The stop placement tells the truth about the entry timing. Here is what this protocol costs you. Nothing. Not a single point of profit. The move you feared missing, the one that starts the second price breaks through, is still there. You capture it on the next candle. You miss the first 1 or 2 points. You keep every point after that. Here is what this protocol saves you. 65% of your losing trades. The ones that stopped you out before the move developed. The ones where you were right about the direction, right about the setup, right about everything except the timing. Go back to where this started. You identified the level. You watched the approach. You felt the momentum. Every one of those things required skill, real skill, and the setup worked. The breakout played out. The market did exactly what you predicted it would do. The difference between the trader who profited from that setup and the trader who got stopped out is not intelligence. It is not analysis ability. It is not system quality. It is 4 seconds of patience, the time between a candle reaching a level and a candle closing above it. 4 seconds. 1 candle. Discipline does not always look dramatic. Sometimes it looks like a cursor hovering over the enter button and a hand that refuses to click until the candle closes. That refusal, unremarkable, invisible, frustratingly quiet, is what professionals do on every breakout setup they take. You are not waiting because you are afraid. You are waiting because you understand something that took most traders years and thousands of dollars to learn. Price touching a level is a question. Price closing above a level is an answer. And you do not trade questions. You trade answers. From this moment forward, when you see a breakout forming, the question is not, should I enter? The question is, where does this candle close? That single shift in framing is worth more than any indicator, strategy, or system upgrade you will ever buy. 1 candle. Every time. If this hits you somewhere real, if you have lost trades that were right in direction but wrong in timing, tell me in the comments what asset or time frame you trade most. I will go deeper on breakout confirmation for your specific setup in the next video. And if you want more of this, the discipline, the psychology, the specific protocols that separate professionals from amateurs, give this video a like and subscribe to this channel. Because here we do not chase setups, we wait for them.